Hello value investors, thank you for joining me. In today's video we're going to talk about TripAdvisor and why I believe that there's not a lot of a bullish thesis to be built here. One could even argue that the stock is overpriced. So if you're new to the channel, please subscribe now so you can get my next video installment. Let's get started. Essentially, TripAdvisor looks quite cheap on a trailing metric. Any type of trailing metric you look, the company is an asset-light business, so it has a predisposition to generating strong free cash flow. If you don't know what free cash flow is, I've got a video right here. So essentially, as it looks at the peak of 2019, when the company was at its strongest, it had -3% year-over-year revenue growth rate. So even when the economy was strong, the company was struggling at that point in time to kind of leverage up its operations to become more user-friendly, to keep its customers engaged, to be more relevant to advertisers. So with all this compounded, of course, TripAdvisor is one of the companies that is facing a very difficult 2020. Hospitality is down, dining is down. It's going to be very, very difficult for the company to make an argument in 2021 it's going to be stronger. Now remember, its Q1 results didn't really get affected significantly until the latter part of Q1. So the results that we see for its revenue growth rate to be down 26% year-over-year is only really for that first part. Without further ado, let's get stuck in. So the trouble with TripAdvisor, as you can see, its revenues have been largely stable in 17 and 18 when the economy was particularly strong, and even into 2019 when, as we know, the economy was particularly strong, its revenue growth rate was -3%. In Q1 of 2020, we see its revenue really fall down significantly. Now, you have to say to yourself, Q1 is not even the worst part for TripAdvisor, because in Q1, it really was only in January and February that it was operating strongly, but in March is when things went really sour. So it still has kind of a positive period here before things really hit the business model. So there is a consistent decline already starting in 2019 that exasperates in Q1. Looking out to Q2, I suspect will be more of the same. I can't see that at any time in 2020 this business is going to ramp up. The argument could be made that the business model is going to have very strong comparisons next year in 2021. But I don't buy that argument. We've seen already this decline starting when it was operating strongly, and to say that it's going to be leaner going into 21, that's not what investors want to see. Investors want to see a strong business that is going to be more relevant going into the future rather than just one that ticks along. Moving on, you can see that at the end of December, its balance sheet was particularly strong. Okay, so it has more than 300 million of cash, has no debt, so it has a net cash position. Okay, and it has quite a lot of current assets. You can see here 530, way offsetting the 435 upcoming. But the company did something which I think is a bit weird. So basically, move forward 90 days, which is just 90 days, the company drew down some debt. Now, that is fine, that is reasonable, but it's kind of weakened its balance sheet. So yeah, so you can say that the total current assets now are over 1 billion, whereas liabilities remain quite low at around 200 million. So yeah, you can see that it's bolstered up its current assets, but now its balance sheet is frail. So you can see that its net cash position is less than 100 million. And so then you start questioning yourself, what is the company going to do with that cash? So when they set off to bolster the balance sheet, but then at the same time they go into and they repurchase approximately 175 million worth of stock, it becomes shocking, because the company is already on its last legs. So to use the excess cash that they managed to get hold of to repurchase shares is strange. Of course, the argument with TripAdvisor is that yes, it's 2.5 billion, but it's on a trailing metrics. Its EBITDA was more than 400 million, so it's not an expensive multiple on a trailing basis. Indeed, on a trailing basis, investors are paying less than 6 times multiple to adjusted EBITDA. But I'm questioning whether investors will continue for very long to look at this investment on a trailing basis, or they'll say that the balance sheet is not particularly strong anymore and its revenue is going to be severely impaired in 2020. When it comes out in 2021, yes, it will have fewer costs, but will the business be more relevant? Will consumers be just clamoring into its platform, and will it be able to position itself as a more relevant platform? And I can't see that happening. I believe that this business has already kind of had its day in the sun, and I believe that investors are probably, like, in best case, fairly priced this stock. I can't see anyone building a strong bullish thesis from here. So to summarize, at 2.5 billion, TripAdvisor's free cash flow in the best case is likely to make around 100 million of free cash flow, and that's not going to happen this year. That may happen into 2021. So you're kind of paying a 25 multiple to free cash flow that may happen in 2021. So it's kind of a difficult investment thesis to build on the bullish side. So for that, I do not believe it's worthwhile investing in. Thank you for watching. Hope you found this video useful. See you soon.